In a whirlwind week that nearly delivered one of the largest trade shocks in a century, the tariff tango has hit a 30-day pause. What exactly unfolded, and how could these tariffs ripple through Canada's housing market? Join me as I unpack the latest trends and data shaping Toronto's real estate landscape. Hi there, Claire Lee here with Royal LePage Terror Equity Elite Realty here in York Region, Markham, Canada. Thank you so much for tuning in and welcome back to the channel. If you find any of this information useful, please consider a like, subscribe, and share. It is free and goes a long way in supporting the channel. And if you or someone you know who's looking to achieve real estate goals in 2025, don't hesitate to reach out anytime. Simply email me directly with a bit about your situation, and my team and I would be happy to connect and explore how we can make those goals a reality. In January, the average selling price for all property types reached $1.04 million, reflecting a 1.5% year-over-year increase. However, on a seasonally adjusted basis, it saw a modest 2.1% dip compared to December. A total of 3,847 homes were sold, down 7.9% from the same period last year, but seasonally adjusted figures show a 10% increase from December. Active listings climbed to 17,157, marking a 70% increase compared to the same time last year, and an 11% rise from the previous month. It's worth noting that while active listings had been steadily declining from September through to December, the recent uptake in active listings between December and January was primarily driven in the condo segment, but more on that later. The months of inventory MOI metric, which measures how long it would take for all available inventory to sell, stood at 3.5 in January across all property types, up slightly from 3.4 in December. This metric is a crucial indicator offering valuable insights into whether the market favors buyers or sellers. Understanding the MOI helps tailor strategies to your specific situation, empowering you to make well-informed decisions. Let's take a closer look at specific property types, beginning with detached homes in January. Detached homes accounted for roughly 41% of total sales, with 44% of those transactions occurring in the $1 million to $1.5 million price range. In January 2025, the average price of a detached home was $1.38 million, showing a slight decline compared to the overall 2024 average of $1.45 million. Regionally, average prices in the York region, the 416, and the 905 have remained relatively stable over the past 6 months. Now let's turn our attention to the condo apartment segment, which represents the second largest share of total sales. In January 2025, condos made up approximately 30% of sales, with 57% of those transactions falling within the $500,000 to $700,000 price range. The average price of a condo in January 2025 was $671,000, showing a slight decrease compared to the overall 2024 average of $703,000. Regionally, average prices across York Region, the 416, and the 905 have remained relatively stable over the past 6 months, with a price difference of around $50,000 between the highest and lowest averages. Of course, this can vary depending on the specific neighborhood and location. So how could tariffs impact the Canadian housing market? The reality is nobody knows for certain, but there are key scenarios worth monitoring closely, each with the potential to impact buyers, sellers, and current homeowners. Scenario 1. If tariffs resume after 30 days, construction costs could skyrocket. Canada's construction industry relies heavily on U.S. imports. Tariffs would drive up already high construction costs, and if sustained, a persistent tariff of this magnitude has RBC estimating a potential 3.4% to 4.2% hit to GDP. Delays and cancellations could follow. Builders like those represented by the Residential Construction Council of Ontario are warning of project slowdowns as supply chains scramble to adapt. Toronto's already fragile pre-construction market could face further pauses, with more projects at risk of folding. Expect higher prices for new construction homes as builders pass rising costs on to buyers. In the resale market, fully renovated properties could command even steeper price tags as sellers factor in these increased costs and hold firm on their expectations. A prolonged tariff war could push Canada into recession, with forecasts suggesting unemployment could rise above 7%. Fear of job losses or economic uncertainty may cause buyers to pause, shrinking demand and stifling any momentum from the recent interest rate cuts. However, the Bank of Canada could respond by slashing interest rates even further to stimulate growth, potentially easing some of the pain for would-be buyers and current homeowners with mortgages renewing in the second half of 2025 and into 2026. In a worst-case scenario, depending on the severity of the situation, the Bank of Canada might even resort to an emergency rate cut similar to those measures taken during the pandemic, just to keep the economy afloat. Scenario 2, a permanent pause on tariffs. Even without tariffs, Canada's economy was already on shaky ground. In this scenario, the Bank of Canada might cut rates further to spur growth and keep borrowing costs low. Construction costs would likely remain stable, and buyer confidence could rebound as the market finds its footing. This stability would help restore momentum, creating a more balanced environment for both buyers and sellers. Scenario 3, somewhere in the middle. Trade tensions aren't likely to disappear anytime soon, leaving us in a middle ground. Canadian mortgages could find themselves in the crosshairs. Fixed and variable rates are currently trending downward. On the fixed side, Canada's 5-year bond yield recently hit a 3-year low, driving fixed mortgage rates down earlier in the week, though they've since edged up slightly. Why? Because during times of trade uncertainty, investors often flock to safer bonds, which lowers borrowing costs for the banks. On the variable side, the Bank of Canada faces a tough balancing act. Tariffs could fuel inflation due to higher import costs, which simultaneously slowing economic growth, potentially forcing the central bank to cut rates to stimulate the economy. This delicate dance could leave borrowers navigating a complex and unpredictable rate environment. Interest rates and the Federal Reserve. On January 29, 2025, the Bank of Canada cut interest rates by 25 basis points, while the U.S. Federal Reserve held steady, widening the gap between the two countries to 125 basis points. The question of how much further Canadian rates can diverge from those in the U.S. remains a key focus for markets and policymakers. The Bank of Canada's next interest rate announcement is scheduled for Wednesday, March 12, 2025, while the U.S. Federal Reserve is expected to make its next announcement around March 18 or 19, 2025. These upcoming decisions will be closely watched as they could signal direction of monetary policy on both sides of the border. What's happening with the wave of mortgage renewals in late 2025 and 2026? According to CMHC, as of December 23, 2024, mortgage delinquency rates remain relatively low at 0.17 as of Q3 2024. Additionally, Canadian mortgage delinquency rates are significantly lower than those in other nations, such as the US. If interest rates continue to decline, it could help ease the burden for homeowners as they renew their mortgages. It's worth noting that due to Canadian banking regulations, even those who secured mortgages at rock bottom rates during the pandemic were still stress tested at rates 2% higher than their contracted rate. This buffer has likely helped mitigate some risks. That said, anecdotal evidence suggests that some of the strain may be felt among investors with investment properties, particularly those experiencing negative cash flows for extended periods. These investors may now be looking to offload their properties, contributing to the growing inventory in the condo market. What's happening at the ground level? Here are some key data points to consider. According to January TREB data, there were just under 6,000 sales on a seasonally adjusted basis. This represents a 10% increase from December. This shows that there are still plenty of buyers and sellers actively engaging in the market. If real estate is part of your 2025 goals, here's what you need to know. Sellers. Prolonged tariff concerns could unsettle buyers, potentially leading to higher inventory levels and softer pricing. However, Lower mortgage rates are helping to sustain demand, as there's still pent-up demand from buyers who have been waiting on the sidelines. For those who have priced their properties accordingly and remain open to feedback and willing to negotiate, I am seeing homes sell within the average days on market for their respective neighborhoods. Buyers. Trying to time the market is like predicting the weather 6 months from now. No one can say for sure. But if you're a first-time home buyer who's already pre-qualified, the math makes sense, and you're ready to stop paying somebody else's mortgage, there are some incredible opportunities in the market right now. By the way, don't miss our team's latest listing, a stacked 1-bedroom condo townhouse in Liberty Village. Check it out. The truth is, it's easy to get caught up in the wave of negative news. And while the Canadian economy may be facing challenges, the reality is that the severity and the impact aren't the same for everyone. People are at all different stages of life. Some have had years to build up substantial savings, while others are just starting out. The bottom line, prepare for the chaos, but hope for the calm. The severity of tariffs will likely continue to be a wild card, but Canada's housing market has weathered tougher storms. If you're looking to achieve your real estate goals in 2025, stay informed, stay flexible, and be ready to adapt. Thanks for watching. If you found this video helpful, don't forget to like, subscribe, and share. See you in the next one.